Good afternoon, good morning, good evening if you're calling in from a different country or different time zone. July has been an interesting month for the property market, and I think we all got a little bit shocked by the news yesterday. Maybe not shocked, but intrigued as to how the South African Reserve Bank increasing the interest rate by 0.75 basis points. How that's going to affect the property market. Is that a good thing? Is that a bad thing? And then also, there's been a decline in the good standing ratio because of geopolitical events. So that's what we're here to discuss today. If you are joining live, aware, thanks. You're welcome to post your questions or comments in the chat function. I will, at about halfway through my presentation, I'll take some time to answer some questions. But I think for the most part, most people will be watching this as a recorded version. Anyway, I hope you enjoy. Let's jump right in. So, the reason why I've decided to do this webinar is because of this tweet that went out yesterday, which is essentially that the South African Reserve Bank has increased the repo or repurchase rate by 0.75, making the repo rate 5.5. That then has a direct influence on our prime lending rate. So we're going from 8.25 to 8 to 9. So I think this is a really timely discussion because the reality is that this might not be the end. It might actually continue going up.
I educate people to reach financial freedom through property through cash flow positive investments, specializing in the low income multi-let residential market.
So let's jump into inflation because before we can understand the repo rate, the prime lending rate, and the impact it's going to have on the property market, we have to understand why we have increases and decreases in interest rates. And the reason is because of this thing called inflation. Inflation, in simple terms, is the rise of products, goods and services. Things become more expensive. You've got more expensive petrol. You've got more expensive energy. Your food goes up. So inflation is the rate of increase in which prices go up of general goods and services over a period of time. For instance, here's a quick graph to show you the impact of inflation over a cup of coffee over the last 50 years. So starting in 1970 and now leading up to 2022. And this isn't just coffee, everything tends to inflate. Things become more expensive. This is just to show you the last year. So from May 2021 to May 2022. This was the increase in certain products. You've got eggs at 32% increased in cost by 1 year. Poultry, milk sitting at 17%. Coffee, baked goods, dining out, fruits and veg. This is just from a food perspective, the inflation rate of food over the last 7 years. So from 2015 up until we hit COVID at about beginning 2020, there was a bit of a spike in food costs because of that pandemic, and we started to get normality, and then Russia invades Ukraine. Ukraine being a massive supplier of grain and food products, it's now pushed our inflation of food far beyond what we saw during COVID times, which is quite scary. So our COVID period was already a bit of a shock to the system. We saw this great increase in insecurity of food, and then now with the war going on. And the reason why the South African Reserve Bank, the Fed chair in the US, and the monetary policy governance team in Europe have all increased rates, because everybody is fighting inflation. The thing is, we don't want things to continue inflating. We don't want coffee to become unaffordable, or eggs, or food. So we have to fight inflation. And that's the thing about the South African Reserve Bank, is they've got a dual mandate. They want to push growth and they want to curb inflation. But these two are two faces of the same coin. By increasing growth, you increase inflation, So by printing money and providing low interest rates, we've now gotten a catalyst for high inflation. Just to give you a bit of perspective as to how big the problem is currently when we're looking at inflation. This is the US consumer inflation in May of 2022, which was sitting at the highest ever in more than 4 decades. In the last 40 years, inflation has not been as unchecked as it is now. And you can see that by this graph in 1982, in January, there was an 8.4% inflation rate, and now in May, 8.6. And the main reason for this has definitely been, I think, the printing of money, the easing of monetary policy. I think that's really driven this kind of out of control. This gives you a sense over the last 10 years as to what the price, what the inflation has been per product. So like gasoline, obviously has been up now because of the Russia crisis and Russia being one of the big OPEC oil providers. That's made gasoline go up by 48%. We're seeing 24, 25, 26 Rand a litre for petrol. Guys, I mean, that's crazy. Energy costs are up 34%, natural gas 30%, electricity. I'm not trying to paint a picture of gloom and doom. In fact, I'm trying to give reason as to why we had to increase interest rates, because look at how inflation is running amok. And if inflation goes up too much, everything becomes unaffordable, right? Now, to understand how inflation impacts an economy, we have to understand what an economy is. An economy, in a simple definition, is the sum of all transactions made in a society. So my spending becomes somebody else's salary, someone else's salary becomes somebody else's spending becomes my salary. And as we spend more, we grow the economy. So when more people are buying cars, the car market grows. When more people are buying properties, the property market grows. More people investing, more transactions happening, your economy grows, right? So what the South African Reserve Bank does is they control monetary policy to either stimulate growth or to tighten monetary policy in order to curb inflation. Those are the two things they can do. They can either increase interest rates if they want to tighten policy and they want to make it harder to access money, or they can lessen the interest rates to be able to stimulate the economy, to let more credit go out and thus grow the economy. All right, so it's a balancing act. In terms of how the South African bank works, it's not an actual bank. It's not a commercial bank. It doesn't work for the end consumer. What the Reserve Bank does is they dictate the price at which they lend to the commercial banks. Right, so they lend to the ABSAs, the Standard Banks, the FNBs, your commercial banks. They lend to them at a rate called repo, repurchase rate. It's just the rate at which the South African Reserve Bank lends money to the commercial banks, who then lend on to us, right? So that's what the commercial banks do, the Standard Banks and the everything of the world. They lend money to institutional investors, to companies, to the likes of Greenpoint or Baldwin, if we're looking in the property space, or they lend to private investors like myself, and they lend that at a rate called prime. The prime lending rate is the rate at which the banks lend to the end consumer. So the repurchase rate is from the South African Reserve Bank to the commercial bank, and then prime is the bank lending rate from the bank to us, right? I took the screenshot this morning on the South African Reserve Bank website. That was our CPI for June, 7.4%. It's high. The repo rate was sitting at 4.75, and the prime lending rate was sitting at 8.25. You can now add 0.75 on both of those numbers. So the cost of the repo rate of the bank, the Reserve Bank lending money to the commercial bank, has increased, and all that the banks have done is they've then on-charged that to the end consumer. So you might have seen an SMS. I got an SMS this morning. Let me actually read it. It was from my bank to say your interest has increased. So here we go. South African Reserve Bank recently increased the repo rate by 0.75. So your credit facility rate has increased by 0.75. Okay. More expenses. We've already got the rising petrol costs, but now it's just more. Okay, so let's understand this Reserve Bank. What are they able to do, right? They've got the two levers. They can either increase interest rates or they can decrease interest rates. Those are the only two options that they have. Now, when the Reserve Bank wants to stimulate the economy, what they do is they make the interest rates low. If interest rates are low, more and more people are willing to go and get debt to buy cars, to buy houses, to buy sports gear. And as you create an opportunity for people to spend more spending means a bigger economy. So what ended up happening is when COVID hit, obviously there was a huge drop in our GDP. I've got a slide on that just now. And what the Reserve Bank did to counter that is they said, let's make money cheap. Let's get people using debt to buy cars, to buy houses, to keep the economy going, to stimulate. And what ended up happening is when you decrease the interest rates, more and more people spent. More and more people bought things, used debt to buy houses, buy cars to stimulate the economy. Now we're in a situation where inflation is running amok, and having low interest rates means people are just going to keep spending, and there's going to be more and more growth, and then goods and services are going to become more and more expensive. So what the Reserve Bank has to do now is they have to say, hold up, increase the rate of debt so that less and less people are willing to use debt to buy things and stimulate the economy. It's a balancing act between ensuring enough growth, but then also having inflation in check. So COVID, this is where it started. During COVID, we saw a huge drop in GDP. I mean, look there. That's crazy. You can see there was a steady, between your sort of 0 and 5% growth for most of the time, and then as soon as we hit 2020, we saw a 30% deduction or loss. And that single event is what spurred on one of the biggest loosenings in monetary policy that South Africa has seen. So to explain what I mean by that, look on the left here, you've got a table and a date next to it. The table shows what the interest rate, the prime lending interest rate is for the date on the right of it. So if we start right at the bottom, you see that in 2016 in March, the prime lending rate at that time was 10.5. If we go a little bit closer to home, here highlighted in yellow, you can see from the start of the COVID pandemic, so the start of 2020, we went from a 10% interest rate to, right at the bottom, 7.25. So in 2021, in November of 2021, we had a prime lending rate of 7.25. That's down 2.75 from the high of 10%, which was in 2019. And what I've been saying in every single one of my videos, I hope you've been following and watching my live deal analysis, but I've been saying to everybody, please be cautious about the interest rate you use. Don't use the 7.5 that's currently prime, because it's going to come back to bite you. The economy was inevitably going to recover, and interest rates were inevitably going to go back to pre-pandemic levels. So I've always advised use 9.5, 10% when analyzing your deals to make sure that your deal still works in a higher interest rate environment. So yeah, that's what happened, right? The bank decreased interest rates, stimulated the economy. Now people were buying houses, buying cars, getting involved because of this cheap credit. I mean, it wasn't just property that grew. With easy monetary policy, look at how attractive the US stock market was. So these are 3 equity funds: S&P 500, NASDAQ, and Dow Jones. And then you can see essentially the years as columns. On the side, you've got all the months. And at the bottom of each of these charts, you've got the overall performance. So in the S&P 500, you've got 4 years of returns. In 2018, it was a negative return. But from 2019, 2021, we saw 28% growth of the fund, a 16% growth, and a 26% growth respectively. That's huge. Guys, in the NASDAQ, in 2020, there was a growth of 43%. The Dow Jones also did really well. So when you've got low interest rates, you're stimulating economic activity. More people are spending and transactioning, the economy grows, things go well. So this is fantastic, right? We were heading into a bull market. And a bull market is a fancy word or a layman term for things are growing at 20% plus. A bear market is the opposite. Things are losing or declining at 20% plus. And then this little thing, inflation hit, right? So we've got our target of between 2 and 4% as an inflation rate in South Africa. But what you can see on this graph is we're sitting at 8.5%, 9%. And this is really, this has been the spark that has stopped this bull market from going. So the South African Reserve Bank said 0.75. What has that done to the economy? Well, it made it tougher to transact. And what we've seen is pretty much a collapse of growth. Here you can see the last 6 months worth of performance for the S&P, the NASDAQ, and the Dow Jones. I have a bit of money in these stocks, and it's been very hard to see my money disappear. But luckily, I also have a lot of money in property. And property tends to be a bit more inflation proof than stocks. Stocks tend to get, or your risk assets tend to get hit a lot more when there's changing monetary policy. Whereas, properties tend to inflate with the interest rates. So it's a bit of an inflation hedge. So the big question, we understand now that inflation is high. Inflation causes the monetary policy and the Reserve Bank to change its interest rates. So we understand the rationale behind why it's happened. The next question is, what does this mean? We've gone now into much higher interest rate territory. What does this mean for me as the investor? Now, I think personally that it's going to be a good buyer's market. I think there's going to be a lot of distressed sellers hitting the market now. A lot of people that bought property because it was cheap, bought property at 7% interest because they thought, sure, I mean, this is as cheap as it's going to get. Maybe bought 2 or 3 properties that were break even or negative cash flow, but they thought, the debt is so cheap, it's fine. And now the debt just gets more and more and more and more expensive. I think, couple that with the rise in petrol costs, the rise in food costs, the rise and the pressure on the consumer, the financial pressure on the consumer to get by. I see a lot of distressed sellers coming to the market, which is good. That's good. If you're a buyer, if you're a cash buyer especially, this is a very good time to be in the market because you're going to have people coming and selling properties well below market value because they're in trouble, they're distressed, whatever it may be. So if you've saved your cash well, now is a really good time, I believe, to be in the property game. It doesn't come without its risks. This was a question by Masai. Is it a good time to buy now? Yes, I think so. I think it's very dependent on the strategy that you use, the area, how well your team is, how big your portfolio is that you can take on more risk, your risk appetite. There's a lot of factors that you have to take into account. I would recommend that you go check out my video on YouTube called Getting Started in Property. That'll give you a really good sense of what steps you need to take. And as long as you follow the principles, yeah, I think it's a really good time to invest. Just as an example, this is more Cape Town focused, but it shows that there is some resiliency in the property market. So SA's housing market is booming, especially in Cape Town, despite rising interest rate. This was done on the 20th of July, so a couple of days ago. And this was essentially a report by Remax where they're sharing some statistics of their consumers. The third bullet is really important. Bond registrations recorded nationally were up 30% compared to the same period last year. So things are better. 30%, there's 30% more activity happening than last year. And point number 4, the number of sectional title units sold countrywide grew by 50%. So I think there's still some resiliency. I think you'll see when I get to the TPN slides, I think there's a huge opportunity now to be getting in as a buyer. But you have to have the risk appetite. You have to know what you're doing. You have to follow the principles. Buy low, refinance at attractive rates, make sure that it's cash flow positive from day one. Only focus on areas with good yields or strategy with good yields. There's basic principles that when you follow them, it's really it's a good time to be an investor. I'm going to take a second here and just see if there are any questions. Hi Lawrence, thank you for hosting the session. Aware, it's absolutely a pleasure. Myth of Italy. Hi, I recently got approved for a bond. I just want to check, as the interest rate increases or decreases, my bond moves at the same rate? Question mark. So essentially my approved rate will be 0.75 higher now. That is correct. Great question. So Myth of Italy, I'm sure that's not your real name, but I'll speak to you as if it was. Your interest rate is definitely going to go up. Your bond rate is going to go up. Remember, when the repo rate increases to the commercial banks, the banks just onset that cost to you as the end consumer. So if the Reserve Bank was going to go up by a percentage or 2% or 1, whatever it is, that would then directly affect what your bond rate would be at. So you actually kind of preempted my next slide, which was to go to Property 24 and figure out what your payment's going to be. So you just go to Property 24, go to the calculators. They've got a mortgage bond calculator. You put in the purchase price, the deposit, the interest rate. I've used 9.5 here. So currently prime is at 9%. So if you've got a bond at prime plus 0.5, then 9.5 is going to be your effective interest rate from today onwards. A loan term of 20 years, and then on the top right it gives you your monthly bond repayment. So yeah, go work out what your bond and your debt is going to be. Hopefully, I hope for your sake you have bought in the right area, bought the right investment, and you know that you've got the kind of yield to cover that expense. And the thing is, property is a debt business. The only way you truly scale your property portfolio is by using other people's money. You can use private finance, you can use bank finance, whatever it may be, but you have to use other people's money to grow and scale, which means this is a business that's very sensitive to changes in the interest rate. So if you're serious about building a portfolio and you want to live the financially free, travel the world and live off your passive income, you have to understand when monetary policy is becoming tight, when to take more debt, when to start paying more debt off. I'm in the situation now where I use a lot of private finance, which means I don't really have an interest rate worry because the private finance buys equity in my deals. So there's no interest between the parties. So when times are tough, like now I'm spending a little bit more money paying off my debt with the bank and with my commercial finances because debt's expensive now. So I'm trying to use some of my additional cash flow to lower that burden. You've got to, if debt is such an important part of your business, you have to get comfortable with it and know what indicators are telling you when it's going to be good or bad economic times. Finally, just on this question of whether it's a good time to buy and what the impact is going to be, I think it is a good time to buy because I don't think the rate is doing that much to a purchase. Here you can see bond amounts, what the payment would be at 8.25, which was prime, and what it's doing now at 9%, which is the current rate of prime. And then on the far right, you can see the additional payment. So for 750,000 Rand purchase, it's an extra 358, which is not huge. If you're going down to your high-end 5 million Rand property, it's about 2,500 increase. So yeah, it's going to have an impact. I think it's going to be a good one. And the thing is, we don't really have another choice. We have to fight inflation. So the Reserve Bank, although I think they were being maybe a bit conservative, I think a 0.5 could have been enough. They want to fight inflation now before it becomes a real issue, and I appreciate that. So that is everything that I have from a inflation and monetary policy perspective, and everything around interest rates. Obviously, as you post more questions or as people post comments on this video later on, I will respond. Let's jump into the TPN Rental Monitor. So this is a report that I get on a quarterly basis, and I really enjoy reading through this because it gives me a sense of what the market is like. The key message of this report is that the rising cost of living is reflecting in the residential market, guys. It's, we were finally starting to recover. COVID was starting to become a thing of the past. Tourism was coming back and everything was starting to kind of fit into place. And then the geopolitical events of the war in Ukraine, it's having a massive impact on the end consumer, on all of us. What you see on this graph here on the right, the rental market strengthens despite consumer woes. So they're tracking essentially three key things here on this graph. The gray piece of the graph is the market strength. They're testing is it more of a supply market, is it more of a demand market? We're currently sitting at 52.8%, so close to equilibrium. So there's a healthy balance between supply and demand currently. The blue graph, or the blue line, is telling you what the national vacancy rate is. So the rate of emptiness in the units. And you can see that there's a nice correlation here between the blue and the gray. As your demand suffers, or as there's not that many tenants that want to rent, that means you're oversupplied, under demanding, then your vacancy rate tends to rise. And that is directly influenced by this thing at the bottom here, unemployment. As you've got more unemployment, you've got more people going to informal settlements as opposed to formal settlements, which means there's less demand for tenants in the suburbs, and you tend to have a vacancy problem. And then the green line is telling you the escalations, the rental escalations. I think that's where the big opportunity is. You can see here from 2006, it was sitting at 5.5%, 6%. Steady decline. Then we had COVID, we had a massive decline, and we've had some recovery now, and I've got a sense that this line is now going to start going up, and we're going to go back to the 5-6% of the world, especially in a high inflation market. Inflation, property is a bit of an inflation hedge because as things get more expensive, our rent also gets more expensive. So it tends to track inflation. Another key thing to look at on this report is the national unemployment rate, and I think this is really where South Africa, this is very sad and such a big opportunity to change things. Our national unemployment rate is sitting at 34.5%. There is some light at the end of the tunnel with 370,000 more people employed in Q1 of this year than Q4 of last year. But we're sitting with 7.9 million unemployed, of which 3.8 have stopped trying to find a job. And then unfortunately the youth are the biggest losers, with 64% unemployed between 15 and 24, and then 42% between 25 and 34. Tough economic times, guys, very tough. One of the things that also stood out on this report is that there's been a decline in the good standing. So we had this recovery, we had COVID hit, things were hectic, interest rates went down, stimulated the economy, things were looking up. And then, by the beginning of this year, things were starting to recover. The consumer was getting stronger. The vacancy rate was, recovering. And then the whole war happened, and the increase in goods and services and living costs. And that's what's happened here. We're starting to see people missing payments. Your good standing ratio is not what it was. There's been a drop, and this is based on the financial pressure that the consumer's under. So I wouldn't be surprised if this dips again, not to pandemic levels, but it's we have to understand the macroeconomic and geopolitical events have a direct impact on our economy. So as long as we can stay abreast and understand all of these external factors, we can make better internal decisions in our investment. This is one of my favorite slides because I think this shows the opportunity of buying into a business that hedges against inflation. So here you're seeing two lines. The green line is your rental escalation. We've already looked at this one. We saw that it was hovering 5.5. It then dipped to into the negative. And in the Q1 of 2022, it's now recovering at almost 2%. Probably going to see that hit about 4-5%, I would assume. The light blue is telling you your capital growth rate. Again, in 2013, and 14, we were in a bit of a boom bubble market there because, we were sitting at almost 9% capital growth. Then we had a bit of a steady decline downward. I would say we're probably at the bottom of the market now. If you're looking from a technical perspective at the chart, I would say, Q1 of 2020 was probably the lowest. That's when most of the properties that I looked at were quite undervalued. And we're going to slowly start seeing a bit of appreciation. So there's huge opportunity. I think if you're a cash buyer, if you've got some cash saved up now and you know what you're doing, I think you can make a lot of good purchases and make a lot of money. The vacancy rate by rental band, so depending on what kind of market you target, I target the 3,000 to 7,000 range. So 3,000 to 4.5 is sitting at 12.8% in terms of vacancy. Your 4.5 to 7,000 sitting at 9%. So these are just the kind of stats that I would include in my numbers if I'm targeting that sort of price brand. In my property app in the tool, I would then use 9 or 10 or 12% vacancy rate because I know that that's probably a realistic, thing to use, and that's why TPN is such a great tool for me. It takes all this data and it informs my decision making. So that when I run my numbers, I know I'm making an informed decision as opposed to just hoping that the deal works because there's low interest rates. This is my last slide before I bid you a farewell. This is something new added to the TPN rental report. It is the Tenant Squat Index, and it shows the likelihood or the tendency of squatting. There has been a bit of an increase, which is a sign of worry. But we're looking at 0.03% growth to 0.04% over a 10-year period. So I don't really look at this with too much weight. I like to use the slide because I think people overestimate how often this happens. I think people are really scared to get into property because they think squatting happens like 20% of the time. No, squatting happens 0.04% of the time. That's a very minimal risk, especially if you're looking after your tenant, you're providing a good service, and you don't let them get behind. So guys, that's my story. I'm sticking to it. Thank you very much for joining me on another live broadcast. I'm going to end with a couple of questions. So we've got another couple here on the right. So first question is, Are tenants going to struggle to pay rent? Should I continue growing my rental portfolio considering the risk of tenants paying rent? That's a great question. So are tenants going to struggle to pay rent? Yes, without a doubt. That is unfortunately what's going to happen if you're struggling to pay you're struggling to pay for petrol, you're struggling to pay for food. Yeah, the end consumer is being hit very hard at the moment. Your second question, should I continue growing my rental portfolio considering the risks of tenants not paying? I'm going to. I think I've got quite a high risk appetite, but I'm definitely going to increase the rate at which I'm buying at the moment. And the main reason is because I believe the property market is going to go down. With distressed sellers coming into the market, you're going to have an oversupply. So it's going to be easier for me to buy at a discount. And if you're buying at the right price, and it's cash flow positive, and you've put in your risk metrics for vacancy rates, and the deal still makes financial sense, and there's still a good return, then yes, I would go for it. Whether you're, some people would disagree with me. Some people would say, what, right now we're in uncertain times. We don't know when the interest rate is going to go up more. I'm going to hold off. I'm going to take a step back because I'm not comfortable investing in this unknown or uncertain environment. I can't really answer that for you. I think you've got to look at the information and decide. I think it's a good time to be a buyer, but you have to have your cash and you have to know what you're doing. Let's see here. Terry Hector. Hi, Lawrence. This is so informative. Thanks so much. Brother B. Yeah, you're always welcome. Thanks for joining the live stream. Appreciate that. Let's see. Another question here is, what do you think the interest rate's going to do in the next 6 to 12 months? That's a great question. And instead of telling you what I think my assumption is, which is, it's pretty much subjective, I'd rather tell you how I would go about analyzing the data to make a decision. So the key thing I would do is I'd go to the South African Reserve Bank website and I would look for consumer price index. And what they do is they track the consumer price index over the last 10 years. I mean, they've got lots of data. That is a really good indicator as to whether the interest rates are going to go up or down. So when your consumer price index, when your inflation number goes up and up and up, the only lever that the South African Reserve Bank has is to increase interest rates to be able to curb that. So as long as we see a bit of a recovery or slowdown in inflation, we should see a slowdown in the increase of interest rates. So I wouldn't tell you I think it's probably going to go up another 0.5, maybe 0.75 over the next 6 to 12 months, and I think then we should be pretty stable. But we have to look at how the inflation numbers grow. So go check out the South African Reserve Bank website. Last question here from Angelo. Thanks for the update. Quick question. When inflation rise, does it mean your equity in property rise as well? So that's a good question. Yes. Property is a bit of an inflation hedge because, as we saw with the slide from TPN, the blue graph and then the green graph, which showed the rental escalation and the capital appreciation escalation, they were both recovering and they were both doing quite well. So again, it's dependent on area. I think there is going to be a 4, 5, maybe 6% capital growth rate. But that depends on the market, right? If you're in the low income market, you're probably looking at 1 to 2%. If you're in the upper income market, you're probably looking at 7, 8%. But I think our capital growth is going to do well. I think the rental escalation is gonna be okay. I think it depends. It depends now what happens in this war with Russia, because Russia is a key contributor to petrol, and Ukraine is a key contributor to food. So, we don't want those prices to keep going up. So the longer the war drags out, the more expensive those consumables become, and the more under pressure our tenants become, and the harder it is for them to pay rent. So yeah, I mean, look, guys, I'm not a professor. I don't have a crystal ball. I don't see into the future. Everything I've learned about property has just been out there being in the market. So I don't really have any formal education. So it's hard for me to say with certainty, this is what you must do. I believe in trying to teach you principles and educating you on my thought process so that you can replicate that thought process and make an informed decision for yourself. There's going to be risk in any business that you take on. I've decided that I'm happy to take the risk that the property business poses. The biggest risk being debt, right? If you're not comfortable with debt, property is not the right asset class for you, and you should rather focus on something that's less debt heavy. Okay, guys, it's been a pleasing pleasure and a privilege to chat with you again. Thanks so much for your time. I'm going to end with one quick video, and then I will see you later. Cheers.
I hope you enjoyed that video. Give it a thumbs up if you did. Please go and check out my YouTube membership. You get access to exclusive content. I'll also analyze live deals on your behalf. So go check out my YouTube membership for that and so much more.